This has been going on. The VIX has been rising, and that's the focus of Navigator.
That's right. So with that volatility index kind of gently moving higher over the last few months, at the same time that the S&P 500 has seen the gains that we've seen towards record highs, our next guest says that these two things together are not typically a great scenario, and they could signal a divergence in market sentiment. So what does it all mean, and what should we be looking out for? Joining us now to break it all down is Brian Stutland, the Chief Investment Officer over at Equity Armor Investments, a guy who knows options, futures, derivatives up the wazoo. So, Brian, take us through the volatility measure. The VIX, it's kind of like this thing that maybe market professionals talk about often, but maybe retail investors don't often focus as much on. What is the VIX telling you with the S&P 1 point away from record highs?
Well, the VIX measures option premium in the S&P 500, and primarily it's based off of put option contracts. These are contracts that allow people to insure their portfolio on the downside. And when the VIX starts sort of rising or holding in there, what that tells me and what I've noticed is that institutional traders are buying put protection. They're buying insurance on their portfolio. So even though the market's, we all feel good right now, it's hitting all-time highs, but we see the VIX rising. These are institutional traders that are looking for a hedge. They're looking for some sort of volatility event to take place over the next, call it 30 to 60 days. And when you look right there, look, after the election, after everything kind of sort of settled out, the week from after the election until now, the S&P 500 is at all-time highs. It's moved higher, and the VIX has moved higher. So this is all indications that there is some level of concern on the institutional part that this feel-good rally is just not going to continue.
So, Brian, I'm going to put it in context for the viewers out there, because if they look at the chart, it has gently been climbing, but the VIX is still languishing right around that kind of 13 to 14 level, well below historical averages. That suggests to me institutional buyers are buying insurance because it's relatively cheap compared to history. Take us through the downside trade that you were putting on.
Yeah, that's correct. So it is relatively kind of cheap here, and I think it makes sense. Look, we've had some nice gains on the year. I want to look to lock some of those in, right, and protect my portfolio. So I can buy a put March option contract, let's say, going out to the end of the quarter on SPY. That's the S&P 500. If I buy one contract, it basically protects me against $50,000 worth of investments in the stock market, right? So I can just do this sort of as a broad-based sort of a hedge trade on a portfolio. If I'm invested 50 grand or so in the market, I can buy one put contract. I do that for about $5.70. I'm spending less than 1% of the value of the S&P. So I'm not really spending a whole lot of premium outlay. I get protection for the next 2 months. And if the market drops, the S&P drops, I can exercise that put, have a short position on from 585 and lower with the break even you see right there, 579.30. And this is a great way just to hedge. It's a cheap time to do it. Act like an institutional trader right now. That's what I'm looking to do for clients. And I think this is a smart sort of hedge, sort of take my profits and protect those.
All right, Brian Stutland, CIO at Equity Armor. Thank you very much. We'll see you soon.